Hello everybody. Let's talk about which IRA might be right for you. In today's world, there are a lot of different types of retirement accounts, and among the most popular are the individual retirement accounts called IRAs. And the first type of a IRA that's most common is called a traditional IRA. A traditional IRA gives you a tax deduction. When you put money into this type of IRA, you can only put in the $6,000 range, plus another $1,000 or so if you're over the age of 50. So it's a small dollar amount that you can put in, but you can at least get a good tax deduction when you choose a traditional IRA. In a traditional IRA, the money grows tax deferred. This means that you don't have to pay any income tax on any of the growth. And if you pull it out after the age of 59 and a half, you get it out at an income tax rate with no tax penalty. If, however, you want to pull the money out before 59 and a half, then you're going to pay a 10% penalty plus income tax on every dollar you pull out. So the first type of IRA is called a traditional IRA, and it's very, very popular. It's very, very common for people who roll money from a 401k or other type of retirement account. They usually roll it into a traditional IRA. Now, when it comes from one of these other retirement accounts into a traditional IRA, that's called a rollover IRA. So a rollover IRA and traditional IRA, effectively the same thing. Obviously, when you roll money into an IRA, then you can it can roll over a considerably larger amount than just the small contribution amount allowed for the traditional IRA. A third type of IRA is less common, but if you're self-employed, you might want to know about a SEP IRA, SEP IRA. And that type of IRA allows you to put in a lot more money. In the year 2021, that's $57,000 a year. It's 25% of your self-employed income, as much as $57,000 a year for a SEP IRA, SEP IRA. Much less popular than the SEP IRA is a simple IRA. A simple IRA allows you to put $13,500 in this year, plus another $3,000 of a catch-up contribution if you're over the age of 50. The simple IRA is not nearly as common as the others. For the simple IRA, it's something that employers with up to 100 employees can set up. The employer only has to put in 2% per year per employee into that. And so if you are an employee and you have a simple IRA, it's pretty much determined for you. And if you have the SEP or you have the simple, what you'll do when you cease employment with your current employer is you'll likely roll that into a rollover IRA. There's another type of IRA called a spousal IRA. What this really means is that people who are married, when one of the spouses doesn't have an income, she or he can still contribute to an IRA. So it's the same contribution limits, the same income limits as the other IRAs, as a traditional IRA. But the person who doesn't have earned income can contribute if the married couple is filing a joint return. Very closely related to that is the inherited IRA or beneficiary IRA. Now, this type of IRA is a little bit different than all the others. It has the same tax benefits, but the problem with the beneficiary or inherited IRA is that the government now makes you pull all that money out within 10 years. So if you inherit a $1 million IRA, lucky you, you're going to want to put it into a beneficiary or inherited IRA, they're the same thing, and pull out, call it $100,000 a year. Because if you pull it all out right now, you'll pay income tax on that entire $1 million. Now, most of us are not going to inherit $1 million in an IRA, but you might inherit $100,000. And if you have to pay income tax on the $100,000, that could be a really big number. So remember that 10-year rule. If you have an inherited IRA, you likely want to keep it and spread out that tax payment for as long as you can, so you can reduce your tax burden. The next type of IRA to talk about is an education IRA. It was specifically set up to fund college planning. It's a very small contribution amount. It's much less than the other IRAs, and its sole purpose is for education. So it's not nearly as popular as all the other types of ways to pay for education, including 529 plans, and we've got a number of videos on that topic on our website. Finally, a non-deductible IRA. Now, the non-deductible IRA, if you earn more than a certain amount, you can't contribute to your IRA. So those dollar amounts are going to be on the screen here. But I got to tell you, if you've got a non-deductible IRA, you might be able to, if you can't contribute so much, you might want to create a non-deductible IRA. The non-deductible IRA will let you put money in after tax, and then you'll keep that money separate and you'll grow it. But the big advantage here is that you might be able to do what we on our website call any rich woman's Roth plan, because the final type of IRA is the one I get most excited about. It's the Roth IRA. And the Roth IRA, you don't get a tax deduction when you put your money in. In the Roth IRA, instead, you're going to put in after-tax dollars. It's going to be the same contribution limits, the same maximum income limits as the traditional IRA, but it grows tax-free. And when you pull it out, it's tax-free. The Roth IRA is fantastic for people in retirement because they can retired people can reduce their taxable income, and that can be very hard to do. And so this is one great way to do it. Now, there are some caveats to the Roth IRA. You've got a 5-year rule. You've got to contribute for at least 5 years before you pull any money out, or you're going to forego those tax benefits. There's a 10% penalty, similar to the other IRAs. If you pull it out before age 59 and a half, you're going to pay that 10% penalty. You don't want to disobey either of those rules in order to go tax-free. Now, which type of IRA is right for you? Well, there are 3 big rules, I say, in this landscape of choosing whether you want a tax-deferred IRA, which is basically every single option I showed you, except for the tax-free Roth IRA. And the first big rule is that tax-deferred is tax-compounded. Otherwise, you haven't grown your money. Holding taxes constant, if you're in the same tax bracket today as you will be 20 years from now when you want to pull money out of your retirement accounts, then you've grown your tax burden at the same rate of return that you've grown your investment return. Holding taxes constant, it has to be that way or you haven't grown your money. Many people would rather pay an absolute smaller dollar amount than an absolute larger dollar amount. So tax deferred is tax compounded. That's the first rule. Now that's the math. The same spendable dollars, if you do the real work there, you see comes true. But the second absolute truth makes that math change in favor of the Roth. And that is that as we age, we lose tax deductions. As it has been, so it's likely to continue to be. As we age, we lose tax deductions. For example, the mortgage. As we age, we tend to pay off our home. We hope, maybe some of us, to have the home entirely paid off by the time we get to retirement. Well, you get an interest deduction. Your mortgage interest is tax deductible. If you've paid it off, you've lost that tax deduction. Another example are kids. You get credits and tax deductions and exemptions and all sorts of benefits for raising children. Well, when they're out of the house and on their own, you don't get to deduct them anymore. We lose tax deductions as we age. The third big reason why you might want to consider the Roth over the traditional IRA is that the government might raise taxes. We are in a low tax period traditionally compared to a lot of times in the past. Income taxes have been much higher than they are today. So if you choose the Roth IRA, you're choosing to pay taxes today at that historically low tax rate compared to the past when tax rates have been higher. And it could very well be that in the future the government raises taxes again for all sorts of reasons. You can make up your own and put them in right here. You might believe that taxes in the future are going to be higher than they are today, and you might want to consider the Roth IRA over the traditional tax-deductible IRA. All right, there you go. There's a brief video. It shows you all the different types of IRAs that are out there. I sure hope that this has been helpful for you. If you'd like some personalized advice, reach out to us at A&I Financial Services. That's assetsandincome.com. Create a beautiful day.